Hi, welcome to another edition of Lipper's Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. The investors in the conventional fund business actually injected about $13.1 billion into the fund industry for the week ended October 17th, 2012. But really, that's not the whole story. It looks like there was some, big numbers coming in. Really, most of that money went into money market funds. We'll get into greater detail. Investors were met with, really mixed news for the week. They had actually good numbers on retail sales were up, home builder sentiment was up, and even the ZOO, which is a confidence indicator over in Germany, that was up as well. But they heard that the European stability mechanism really had kind of a shock put to it, and they said they might not have enough funds to bail out Spain if they came knocking up the door and asking for a handout. So that was of concern. And of course, we've been hearing this kind of European debt issue off and on for quite some time. And also, people, I think, were letting the idea of basically this is the 25th anniversary of one of the biggest market declines that we've seen. It's October 17th today, the day that we're actually reviewing this, 19th today, that we're reviewing this piece. And also, they have the upcoming election hovering over them as well. So we have upcoming election. We also have the looming fiscal debt crisis, and this played into a lot of investors' psyche. They need to get some of this uncertainty off the table before they can move on. But really, the numbers are okay, and the numbers are, we can explain, how they occurred and why they happened. Let's go ahead and move on to our macro group. Equity funds actually saw about $200 million net new money come into their coffers. Taxable bond funds did, grand $3.3 billion net new money into the conventional fund business from that sector. Muni bond funds, again, on their merrill way, have been doing very good over the last several weeks, and we saw about $600 million of new money come into their doors. Now, money market funds, as I said, $10.6 billion of net new money came into that, and really it showed some conservativeness during this kind of the time of anxiety. Keep in mind that we just actually came off 4 consecutive days of plus side performance. I know it sounds ridiculous to even be talking about that, but it was the longest winning streak that we've had in the last 5 weeks for the Dow Jones Industrial Average. So people really had some good reason to cheer, but again, they have this cloud hovering over them, the European debt crisis, and of course the upcoming presidential election and the like as well. So let's get into detail now of how these funds did. If we take a look at equity funds, they were up about 2.26%. I said it was a pretty good week, Wednesday to Wednesday, and they saw about $195 million net new money coming to their doors. Not much, but keep in mind, it's the first week in 10 that they've seen net inflows. If we take a breakdown of this, domestic equities funds actually witnessed about $18 million in outflows, while non-domestic equity funds, they basically saw $241 million of net new money coming to their doors. This is the third consecutive week we've actually seen plus side returns and plus side performance or plus side flows come into their coffers. Now, to break this down a little bit further, we want to take a look at the popular classes in the equity group. Equity income funds saw about $347 million of net new money come into their coffers, and that's for the 17th out of 18 weeks that we've been rolling. So we've been seeing people interested in dividend payers. We've talked a lot about that. International equity funds also were in favor with investors. They saw about $311 million of money come into their doors. Now, we should probably take a look at ETFs, because here's the tale of two cities, and it's been for quite some time. Equity ETFs saw $2.7 billion in outflows. This is the third consecutive week that we've seen outflows, and the big outflow pariah was SPY, last week's favorite. $2.7 billion was the total outflows. Well, $2.1 billion is what we saw exit the doors of SPY. In addition, we saw QEF, which is the iShares S&P 100 index, lose about $700 million as well. And at the very top of the arena, we saw iShares Russell 2000, a small cap index, actually take in some money. IWM is that ticker, and we saw about $352 million of net new money coming into theirs. So really it was a tale of two cities. People were willing to take a little bit of risk going into maybe some unfavorable areas, small cap indices, while taking the SPY and a few others and saying, listen, we're going to sit on the sidelines. We're very concerned with what's going on, even though we're hearing some good news. Well, let's take a look at fixed income funds, because this is the area where investors decided to put their money back to work. For the 19th consecutive week, we saw inflows into this group, $3.3 billion. It's a good, strong number. Second week in 3 that we've seen plus side performance out of this group, about 0.45% return, nothing to really write home about, but certainly positive returns nonetheless. And the big group to take in money was the corporate investment grade debt funds, so about $1.4 billion. This is the 18th consecutive week they've taken in money as well. And one of the big things that we haven't really been talking a lot about is the government mortgage funds. They saw about $611 million in net new money this week, and it's been kind of a slow, steady Freddy for 46 consecutive weeks. this group has actually seen money. Now again, you're not getting the highest yields, you're not getting the lowest yields in a government mortgage, but there's some confidence in there, and there has been support by some of the big players out there. PIMCO Total Return Fund and a couple others areas have been buying in this as well, so we've been seeing some really good returns from that. Now let's take a look at our ETF universe as far as fixed incomes go, and we can see that they saw about $1.1 billion of net new money coming into their doors, with corporate investment grade debt funds taking in the lion's share. $1.0 billion came into their doors. iShares iBox, the investment grade corporate bond LQD, that saw about $32 million net new money, and then we saw AGG and BND, also some high investment grade debt funds do well. At the very bottom, we'll see some of the risk being taken off those portfolios. High yield funds were at the bottom, and also people didn't want to go so low in the returns. They saw treasuries as well at the bottom. Well, that brings us to what we've been talking about for quite some time, and that's muni bond funds. Muni bond funds have really been quite a story. For the fourth week in 5, we saw that they were able to remain out of the red. They had a 0 performance today, but as far as the week goes. But 4 or 5 weeks, they've actually had positive returns or a break even 0 as they did this week. But it's 27 consecutive weeks we've seen net new money come into this group. $575 million came into this group. That doesn't sound like a lot of money, but keep in mind, we're chipping away. We were seeing 300s, 200s, 400s. Now we're seeing 500, 600, and 700 at a whack every single week. It's really getting stronger. So national munis, though, made up about $499 million of that net new money. So a couple of things. People are actually seeing some tax advantages. We're coming close to year end. They're really not sure what's going on in the tax scene. And in addition, we have shown that the taxable equivalent yield is actually quite higher in some of the products offered by munis than they are their taxable brethren. Well, that brings us to the money market funds. And this is the area that we just really don't get any continuity out of it. We saw about $10.6 billion of money come into the doors of money market funds. It's the first week in 3 that we've actually seen inflows. Taxable money market funds, so about $11.7 billion, and that can be broken out into institutionals, took in $10.4 billion, while the retail investor put in about $1.3 billion. And if we get down to the bottom, we see tax-exempt money. They actually saw a little money leave their coffers, about $1.1 billion exit their doors. Well, as we move forward and over the next week, we've got some things to take a look at. September existing home sales came in a little bit weaker than we expected. Actually, it was as expected, but it was weaker than we'd seen in the previous weeks. But it still remains at 2-year highs, so that's a positive. And we'll have to see if people, embrace that as such. Philadelphia Fed came out and said that the index actually grew as well. It's the first time that was in positive territory. It was 5 and some change since April. So really we're seeing some better numbers, and we'll just have to keep an eye on this, on and off again. And I believe investors are going to go into hibernation mode for the next 2 weeks until we get done with the presidential elections. And then certainly they'll be looking at that fiscal cliff as well that we're headed into. But if you want to do more research and find out what areas did best for classifications that you'd like to see flows in, you can go to our website. It's lipperusfundflows.com. If not, join us next week where one of our analysts will talk about the flows trends for that period. Thanks for joining me. My name's Tom Rosine, wishing you the best in your wealth planning and creation.